Yeah, I'm losing my
Trade
edge.
for bonds, Pete. Bond market moving around, equity market moving around. I thought it'd be as good a time as any to figure out how to pair your interest rate trades with other interest rate products and other asset classes as well. Everybody usually interested in the pairs trades dynamic, but today we're not going to start with equities. I wanted to start with the world of bonds and move on from there because we have this small treasury S10Y futures that have broken above $10 recently and look like they're going to move higher. The most activity that we've seen in interest rates since they fell down to actually all-time lows in 10-year treasury interest rates at the midpoint of 2020. It's been a real calm, just grind higher in rates from about 50 basis points or $5 in S10Y all the way up north of $10 or 1% here. But now we're seeing a lot of two-sided action, a lot of back and forth in this interest rate market. And I think it calls for some strategic analysis here and see how you could possibly, I think a lot of people looking at interest rates saying, man, I wish I could have bought them at those lows. But remember, this is the two sides of every trade opportunity where a lot of people kick themselves for not buying, Bitcoin at its lows and now it's skyrocketing. Or interest rates. Oh, I wish I could have bought it at 50 basis points down here in August. I could have doubled, more than doubled that asset's price in the last 6 months. Big move higher. But keep in mind, you can't kick yourself too much because when that market was down at 50 basis points, everybody, myself included, was saying, man, are they going to take this down to zero or even negative? Because we've seen interest rates can go negative. So all of that aside, I want to look at the possibility of getting long S10Y at a lower price now that it has moved higher. And you can use these pairs trades examples. You could flip them on their head to get short S10Y at higher prices. But I just want to run through 3 examples here, starting off with probably the most straightforward example for those people who have traded 10 years or interest rates in the past, with the fact that this S10Y product is a yield-based product that is modeled off of the 10-year Treasury note. You can go to 10-year Treasury futures /ZN to a lot of people, but the ZN future, and you can sell a put spread or a put against that long in S10Y. Now, it seems a little counterintuitive. Why would I be getting long deltas with the short put or put spread in ZN against my long S10Y? Pete, if you are back with us, maybe you can go for that.
It's the inverse. I mean, this is the pure inverse relationship. We know price and yield are perfectly correlated and the inverse of one another. When price goes up, yields go down. So this is what's great is when you create a unique product like the Smalls have done with the Smalls 10s traded in terms of yield. The fit of, if you size it properly, of using existing product to reduce cost basis for a directional trade is very easy to do. And we just need to talk about how do we tame that institutional beast to fit in our world. But they are a wonderful, and the one thing, when you have an inverse relationship, the pairs trade becomes a buy, sell. So that's something we've looked at. I would say out of every 10 pairs we talk about, Frankie, maybe 1 to 2 of them is that inverse relationship. This is one of them where that inverse relationship exists. So when we're buying Smalls 10s, we're looking for long deltas in the inverse product, which is ZN.
Perfectly stated there. And yeah, just a little bit of furthering of this discussion here with ZN against S10Y. You're going to want to look at about 5 deltas there. That's about the notional volatility equivalent if you want to hedge part of that long S10Y position. And I know I put there that you could do the 5 delta put, but I'd really advocate more than anything for the put spread to define the risk in there, because the last thing you want is long S10Y and then some hedging long deltas in ZN. You see that S10Y and yields move higher, and thus simultaneously the price of the 10-year note via ZN will move lower, and you don't want to gain too many deltas in your long ZN position, which is supposed to be a hedge. So I would look at, if you're looking at ZN in your platform, I would look at half a point wide put spreads that get you around, $50 to $100. That's what I would do. And I think that's the smallest increment with those put spreads. But moving on to the next product here, and this will be a little bit more comfortable for people because it's an exchange traded product, TBT. What's interesting, Pete, is that this is actually considered an inverse treasury bond product. But you might say to yourselves, and before we created S10Y futures, I told myself that TBT is essentially just a yield product before yield products were cool at the small exchange. But it's just funny that TBT is actually an inverse bond product. But you can see it looks a lot like our yield. And thus, this is more of a traditional straight up hedge. And since S10Y is 100 times the price, which puts it at a product size of about $1,000, options on TBT are just 100 shares times the price. So that puts that product at just a little bit more than $1,000. So I would look at just a straight up covered call in here, long one S10Y future and short, a 50 or 40 or 30 delta call in TBT. Pretty simple.
Yeah, absolutely. And you know what, when you mentioned the 50, the 40 or 30, it's just how much do you want to do a covered call? We usually don't do pairs trades to completely neutralize them, especially in something like this where this is shaving off a little bit. And what's our strategy with this trade? It's not to take advantage of a divergence here. It's to basically add cost basis reduction. So there's your strategy. Now the mechanics speak to how much of that you want to do. And I love the fact that you hit on a great way, and whether we are looking at ZN previously, to start to size this when you look at a put spread is look at what you're trying to make on this long S10Y. And $50 to $100 is a good part of a daily scalp. When you look at putting that put spread in, and I agree with you, naked puts will become disconnected from what you're trying to accomplish if the market actually goes. When you look at that put spread and you're collecting between 75 and $1.25, there's your sizing that starts to really resonate with you. Not only do you see the very clear cost basis reduction, but then you're sizing your put spread at an appropriate point.
And I'm super glad that you brought something up there, Pete, along the lines of how much you're hedging, because there are pairs trades that we do here. Pairs trading to me is a catch-all for, relationship trades, 100% hedge, which is just, like you said, like a divergence or convergence between two similar assets. Here, we're looking at a pairs trade mostly for just like hedging or risk management. Like we started at the top of the segment, essentially trying to buy a market at a lower price or sell a market at a higher price using a very similar product like TBT here. And so that's why, you might say, oh, well, if they're almost the same price and they move almost exactly the same here, why wouldn't I just sell 100 shares of TBT for one contract of S10Y? We're not looking for a 100% hedge for convergence or divergence between the two assets. We're just looking for, the 50 delta is about a 50% hedge. Right. That just means that I'm still long 50% of that S10Y contract, but the call here in TBT, maybe it got me 40, 50, or 60 cents. That gets me 40, 50, or 60 cents lower on my long S10Y price there. And so I'm glad you brought that up, because the final piece here adds a little bit of that convergence, divergence, pairs trading, more kind of traditional aspect to it, which is roping in equities. As you can see here, the one S10Y for 5 shares or deltas of IWM, the chart is showing you that it's been a big collapse in yields relative to stocks. And as you can see here, it's like, wow, this just looks like the fall off in interest rates. And it's because we've seen that fall in interest rates for equities falling. And that's why you've got the back and forth right here, because equities fell right here with interest rates. And so the pairs move back and forth. But the rest of 2020, equities went to new highs while yields stayed low. And so that's why there's a potential for, buying interest rates against equities. And what you would do here is look to sell about 5 deltas worth of IWM. That's the market that I'm looking at here. But you could transfer this to
Russell divergence piece. Sure.
You could transfer it to SPY or DIA, a couple other products there, as long as the size is similar. there. And yeah, what I'm looking for is probably similar to that ZN position. I'm looking at probably a call spread that's worth about 5 deltas that I could get, $50 or $100 for in IWM. And this is one of those buy, sell, because stocks and yields are highly positively correlated here. So those are 3 different ways to pair up your bonds. At the end of the day, trying to reduce the cost basis, get you long at a lower price, all of which can be flipped on their heads for those of you who are trying to
trade the other
sell,
side, sure.
Sell into these interest rates.
Yeah, absolutely. And you know what? 3 distinct strategies, all, and it's interesting when you could actually argue that that's really, you could implement any of these, or actually all of these are very interesting tradable strategies that are truly diversified in what you're looking to get out of them.
Yeah.
So great pieces. And, the call spreads, the put spreads are important. Not only do they give you appropriate sizing, but they also dramatically lowering that buying power of the big institutional future or the little bit more costly to use ETF. So great piece of context, great piece of reference. And again, building out strategies every single day. Fantastic, Frank.